$10,000. The number sits differently depending on where someone is in life. For some, it represents months of careful saving. For others, a significant portion of an emergency fund. For others, still the kind of money that took years of discipline to accumulate and disappeared in a fraction of that time. But regardless of what $10,000 means in absolute terms, what it means in the context of trading is almost always the same thing: tuition. The most expensive kind of tuition, because unlike the kind paid to universities and institutions, this kind comes with no certificate, no structured curriculum, no guarantee that the lessons embedded in the loss will actually be extracted and understood, rather than buried under denial and rationalization. Most people who lose significant money in trading do not learn from it in any meaningful way. They explain it away, attribute it to bad luck or bad timing, or an unusual market event, and return to doing essentially the same things that produced the loss in the first place, now with a smaller account and the same unexamined habits. The loss becomes tuition, only for the minority who are willing to sit with it long enough and honestly enough to understand what it is actually teaching. What $10,000 in losses teaches, when examined with genuine honesty, is almost never what it appears to teach on the surface. On the surface, it looks like a lesson about a specific trade, a specific market, a specific moment where the wrong decision was made. Go back. And it was that one position that ran too far against the entry. Or it was that one week where everything seemed to reverse at exactly the wrong moment. Or it was that particular asset class that turned out to behave differently than expected. These surface-level explanations are real. They describe what happened, but they are not what caused the loss at the level that actually matters. Because the specific trade, the specific market, the specific week are all just the visible expression of something operating underneath. A pattern of decision-making, a relationship with risk, a set of beliefs about how markets work and what trading is supposed to look like that were present before the first losing trade was ever opened. And that will produce more losing trades unless they are directly addressed. The simple rule that changes everything. And it is simple, genuinely simple, which is both its greatest virtue and the primary reason it is so persistently ignored, is this: define what losing looks like before you define what winning looks like. And never let the actual loss exceed the defined loss under any circumstances. Before a position is opened, before any capital is committed, the maximum loss on that position is determined. Not estimated, not hoped to be limited by eventual market recovery, not protected by a mental note that will be revised when the emotional pressure of a live losing trade arrives. Determined precisely, placed as a hard order in the market, and treated as the most important number in the entire trade. More important than the entry price. More important than the target, more important than any analysis of where the market is likely to go. The maximum loss, defined in advance and enforced without exception, is the rule. Everything else is detail. This sounds so straightforward that it barely seems to deserve the weight being placed on it. Every resource about trading mentions stop losses. Every introductory course, every book, every experienced trader who shares anything publicly includes the basic instruction to use stops, to define risk, to know where the trade is wrong before entering it. The information is everywhere. And yet the consistent, repeated failure to actually implement this rule in practice, not to know it, but to implement it with genuine rigor across every single trade in every single market condition, is the single most reliable source of trading account destruction that exists. Not exotic market events, not bad strategies, not bad luck. The failure to implement, consistently and without exception, the one rule that every knowledgeable participant agrees is foundational. Understanding why implementation fails, despite universal knowledge of the rule, is more useful than restating the rule itself. Because the gap between knowing and doing is where the $10,000 went and where the next 10,000 will go if the gap is not examined and addressed at its actual source. The source is the relationship between financial loss and emotional pain, which is not the rational, proportional relationship that good trading requires. Research in behavioral economics has documented extensively that losses register in the human brain with approximately twice the emotional intensity of equivalent gains. Losing $100 feels roughly as bad as gaining $200 feels good. This asymmetry is not a character flaw. It is a feature of human psychology that developed over evolutionary timescales for very good reasons. In environments where resources were scarce and losses were existential, a strong aversion to loss was adaptive. In the context of financial markets, it produces a specific and costly behavioral pattern. When a position moves against an entry and approaches the predefined stop level, the emotional system registers the impending loss with an intensity that triggers avoidance behavior, the desire to do something, anything, that delays or prevents the immediate realization of that loss, moving the stop further away, switching from a short-term frame to a long-term frame to justify holding, adding to the position to reduce the average entry price, telling a different story about the trade that makes holding seem rational. All of these behaviors feel, in the moment, like intelligent responses to a developing situation. They are, in every case, the emotional system overriding the rational one in ways that convert a small, planned loss into a larger, unplanned one. The stop loss exists to interrupt this process at a defined point before the emotional escalation makes rational decision-making impossible. It is not primarily an analytical tool. It is a psychological one. Its function is not to predict where the market will reverse, or to identify the technically correct level at which the trade is invalidated, though good stop placement incorporates that analysis. Its primary function is to remove the decision from the emotional self at the moment when the emotional self is least equipped to make it well. A stop order placed in the market before the trade is entered means that the exit decision, the one that is hardest to make when it needs to be made, has already been made by the rational self in a calm state with full access to the reasoning behind the trade. When the market hits that level, the exit happens automatically, without requiring the emotional self to agree to it in real time. This is the difference between knowing the rule and implementing it in a way that actually works. The $10,000 loss, in the vast majority of cases where it occurs, did not happen in a single catastrophic trade. It accumulated across a pattern of trades where the intended loss per trade, whether explicitly defined or vaguely estimated, was repeatedly exceeded. A trade that was supposed to lose $200 if wrong lost $600 because the stop was moved when it was approached. Another trade that was supposed to be closed when it reached a certain loss level was held because the conviction remained high and eventually closed for 4 times the intended loss. A third trade that should have been a defined loss became a large loss because the position size had been increased after a few winning trades created false confidence, and when it went wrong, the oversized position created an outsized loss. None of these individual failures looks catastrophic in isolation. The pattern they create together is what produces $10,000 in unplanned losses, and the bewildering experience of watching an account decline far faster than any specific bad decision seemed to warrant. Position sizing is inseparable from the stop-loss rule, because the stop-loss alone, without correct position sizing, does not control the actual dollar loss on a trade. A stop-loss placed 20 points from the entry on a position of 100 shares loses $2,000 if hit. The same stop-loss on a position of 20 shares loses $400. The distance to the stop determines where the trade is wrong. The position size determines what being wrong costs. Both must be determined before the trade is opened, and the position size must be calculated from the stop distance and the defined dollar risk, not from how many shares feel right or how much conviction exists or what the last winning trade size was. The formula is straightforward. Maximum dollar risk divided by dollar distance to stop equals position size. This formula should govern every single trade, regardless of conviction, regardless of recent performance, regardless of how clear the setup looks. Conviction does not correlate with outcome in financial markets. Correct position sizing correlates with survival, and survival is the prerequisite for everything else. The concept of risk per trade as a fixed percentage of account equity is the framework that makes position sizing systematic rather than discretionary. Defining risk at 1% of account equity per trade, or 0.5% or 2%, depending on the strategy and the trader's volatility tolerance, means that every trade risks the same proportional amount of capital regardless of the trade's size in dollar terms. As the account grows, the dollar amount risked per trade grows proportionally. As the account shrinks, the dollar amount risked shrinks proportionally, which creates the crucial self-correcting dynamic, where a losing streak automatically reduces the absolute amount being lost per trade, slowing the drawdown and preserving capital for the recovery. A trader risking a fixed dollar amount, regardless of account size, is exposed to the opposite dynamic. Losing streaks don't automatically reduce position size, which means a run of losses can accelerate the account destruction rather than triggering the natural protective adjustment that percentage-based sizing provides. The mathematical implications of percentage-based position sizing, combined with consistent stop implementation, are worth examining in concrete terms because they fundamentally reframe what losing streaks mean for account viability. A trader risking 1% per trade who experiences 10 consecutive losses, a statistically meaningful losing streak, but one that falls well within the normal distribution of outcomes for most strategies, has lost approximately 10% of the account, accounting for the compounding effect of each loss reducing the base. The account is down 10%, which is genuinely unpleasant, but it is entirely recoverable without heroic performance. The same trader, without position sizing discipline, who risked amounts that varied between 2 and 10% per trade depending on conviction, might have lost 30 or 40% over that same losing streak. A 40% loss requires a nearly 70% gain to recover. The mathematical asymmetry of large losses means that preserving capital during losing streaks is not merely important. It is what determines whether the trader is still in business when market conditions align with the strategy again. Losing streaks are inevitable in any trading strategy, and understanding their statistical nature is essential to maintaining the behavioral composure required to continue executing the strategy correctly through them. Every strategy that has a genuine edge has a win rate below 100%, which means that sequences of consecutive losses are not anomalies. They are mathematical certainties. A strategy with a 50% win rate will produce sequences of 5 or more consecutive losses with a frequency that can be calculated precisely from the mathematics of probability. A strategy with a 40% win rate will produce longer losing sequences more frequently. These sequences don't indicate that the strategy has stopped working. They are part of the normal distribution of outcomes that the strategy's win rate mathematically implies. The trader who exits a strategy after 5 consecutive losses, because the losses feel like evidence of failure, has confused a normal statistical outcome with a signal that something has fundamentally changed. The test of whether something has fundamentally changed is not how many losses have occurred in a row. but whether the trades that produce those losses were executed correctly according to the strategy's rules. If every stop was taken as defined, every position was sized according to the formula, every entry met the full criteria, then a losing streak is data about the strategy's distribution of outcomes, not evidence of the strategy's failure. If stops were moved, positions were oversized, marginal setups were taken, then the losing streak is data about behavioral failure, which is a different problem with a different solution. The practical mechanics of implementing the stop-loss rule without exception requires specific structural choices that go beyond simply deciding to use stops. The most important structural choice is whether stops are placed as hard orders in the market or maintained as mental notes. Mental stops are not stops. They are statements of intention that require the emotional self to execute at a moment of financial stress. And the emotional self, under those conditions, will almost always find a reason to delay, to give the trade a little more room, to wait for one more candle, to see if the level holds on a retest. Hard stops, actual orders sitting in the market at the defined level, remove the real-time decision entirely. They execute automatically, regardless of what the trader is thinking or feeling at that moment. Regardless of whether the market is moving fast or slow, regardless of whether the loss feels too large to accept. The automatic execution is not a limitation of hard stops. It is their entire value. The objection raised most frequently against hard stops is that markets sometimes spike through stop levels and then reverse, hitting the stop, and then immediately moving in the direction of the original trade. This happens. It is a real phenomenon, particularly around news events and in less liquid markets, and it produces a specific and painful experience. Being stopped out at a loss and then watching the market do exactly what the trade was positioned for. This experience, when it occurs, is used as justification for not using hard stops, for using wider stops, for using mental stops instead. The reasoning is that if the stop hadn't been there, the trade would have worked. This reasoning is correct in those specific instances, and profoundly incorrect as a general principle, because the instances where the stop prevented a small loss from becoming a catastrophic one vastly outnumber the instances where the stop exited a trade that would have recovered. The trader who selectively remembers the time stops were hit before the market reversed and forgets the time stops prevented. Devastating losses is not reasoning from evidence. They are reasoning from the emotionally salient experiences that confirm what the emotional self already wants to believe. Slippage, the difference between the stop price and the actual execution price, is a legitimate consideration in stop placement, particularly in fast-moving markets or during high-impact news events. The practical accommodation for slippage is to factor it into the risk calculation when determining position size, not to use it as a reason to widen the stop beyond the level that invalidates the trade's thesis. If the thesis is invalidated when price moves beyond a certain level, that level defines the stop regardless of slippage concerns. The slippage affects the exact dollar loss, not the principle of exiting when the thesis is wrong. And in most liquid markets during normal conditions, slippage on stop orders is small enough to be a minor operational consideration, rather than a reason to abandon the practice of using hard stops entirely. The rule also has a temporal dimension that is frequently overlooked. Not only is the maximum loss per trade defined before the trade is opened, the maximum loss per day, per week, and per month is also defined and enforced with the same rigor. A daily loss limit answers the question of what happens after the stop on one trade is hit. Does the trader immediately open another position, then another, compounding the losses through the revenge trading cycle that follows the frustration and urgency of a losing trade? The daily loss limit says no. When a defined amount has been lost in a single session, Trading stops for that session, regardless of how many opportunities appear to be presenting themselves. This is not a signal of weakness or insufficient conviction. It is a recognition that the emotional state following meaningful losses is measurably worse for decision-making than a baseline emotional state, and that continuing to trade in a degraded decision-making state under the additional pressure of trying to recover the day's losses produces predictably bad outcomes. The trades entered during the revenge trade trading phase, after a stop out, are among the worst trades most people ever take, and the daily loss limit prevents them from being taken at all. The weekly and monthly loss limits serve the same function over longer time horizons. If the week has been consistently losing and the defined weekly loss limit has been reached, the week ends regardless of what Thursday and Friday hold. This forces a review period, a structured pause during which the trades of the losing week can be examined with the rational mind rather than the reactive one, during which the question of whether the losses resulted from normal strategy variance or from behavioral failures can be honestly assessed, and during which the emotional reset required for returning to disciplined execution can actually occur. Trading through losing periods without pause, driven by the urgency to recover, consistently produces the kind of accelerated account destruction that makes $10,000 feel like the beginning rather than the end of the losses. The review process is where the rule becomes a learning system rather than just a risk management tool. Every trade should be reviewed after it closes, not to second-guess the outcome, which was probabilistic and not fully under the trader's control, but to evaluate the process. Was the stop placed correctly before the trade was opened? Was the position sized according to the formula? Did the entry meet every criterion in the strategy's rules? Or was it a marginal setup taken because the market was moving and there was urgency to participate? Was the stop moved at any point during the trade's life? And if so, was that movement justified by a change in the trade's thesis or driven by the discomfort of the stop being approached? These questions, answered honestly in a written journal over a sufficient number of trades, produce a picture of behavioral patterns that is impossible to see trade by trade, but becomes unmistakable in the aggregate. And patterns that are seen can be changed. Patterns that are not seen repeat indefinitely. The simple rule: define the loss before defining the win, implement it as a hard order, never move it in the losing direction, size every position from the stop distance, and the defined percentage risk does not guarantee profitable trading. Nothing guarantees profitable trading. What it guarantees with mathematical certainty is that any losses taken will be limited to a defined, survivable range, and that the account will remain viable through the statistical variance that every strategy produces, including the extended losing sequences that occur even in strategies with genuine edges. An account that remains viable can keep trading long enough for the strategy's edge to express itself across a sufficient sample. An account that suffers large, uncontrolled losses on individual trades or sequences of trades may not survive to see the edge materialize. $10,000 is a significant amount to lose. It is also, for the trader who genuinely extracts the lesson it contains, an investment in understanding that changes the entire trajectory of what comes after. The lesson is not that trading is too risky, or that the market is too unpredictable, or that success requires information or sophistication that is beyond reach. The lesson is simpler and more actionable than any of those conclusions. That the single variable most within the trader's control is how much any given trade costs when it is wrong, and that controlling that variable with absolute consistency is the foundation upon which everything else about long-term trading viability is built. Not the most exciting foundation, not the one that produces viral content or compelling trading stories, But the one that is still standing after years of market participation, after dozens of losing stretches, and hundreds of individual losing trades, because every single one of those losses was defined in advance, limited to a survivable amount, and executed through a hard order that did not require the emotional self to agree to it in real time. That discipline, built one trade at a time and maintained one trade at a time, is what the $10,000 was always trying to teach.